Why billionaires are moving to gold and real estate in 2025, the truth banks won't tell you. Why are the world's richest people abandoning cash and pouring their wealth into gold and real estate? In times of global uncertainty, whether it's economic crashes, inflation spikes, geopolitical tensions, or banking instability, billionaires don't sit back and hope for the best. They act quietly but decisively. And time after time, they shift massive portions of their fortunes into two timeless assets, gold and real estate. This isn't just strategy. It's survival. From Warren Buffett's calculated moves in real estate to Ray Dalio's consistent emphasis on gold, the elite are sending a signal, one most people ignore until it's too late. But here's the question you need to ask yourself. What do they know that you don't? In this episode of Bold Steps Forward, we dig deep into the real reasons behind this wealth migration, expose how these moves protect and multiply wealth even in chaos, and reveal what lessons everyday investors can learn before the next crisis hits. Hit that subscribe button, and let's uncover the hidden playbook billionaires use when the world turns uncertain. Chapter 1. The Hidden Language of Billionaire Wealth. When the economy gets shaky, most people freeze. Billionaires, however, move quietly but intentionally. They don't just react to uncertainty. They prepare for it. And if you pay close attention, you'll notice a pattern they follow almost every single time. They shift their money into gold and real estate. This isn't by accident. It's not trend chasing. It's a playbook, a hidden language of wealth that's been used for centuries to protect and grow fortunes during instability. Let's break it down. Gold, the ultimate silent guardian. Gold doesn't yield interest. It doesn't generate passive income. So why are the richest people in the world obsessed with it? Because gold has one job, and it does it perfectly: preserve purchasing power. Unlike fiat currencies that lose value every year due to inflation, gold holds its own. It's scarce. It can't be printed. And it's universally trusted. Throughout history, from Roman emperors to modern hedge fund managers, gold has acted as a hedge against collapsing empires, runaway inflation, and currency devaluation. It has zero counterparty risk. If your bank fails, your stock crashes, or your currency devalues, gold is still gold. During the 2008 financial crisis, gold prices surged as investors scrambled for safety. In 2020, amid pandemic panic and unprecedented money printing, gold once again became a safe haven. And in 2024, as global debt hits record highs and banking confidence cracks, billionaires are doubling down on their gold reserves. But here's the thing, they're not buying gold after it hits the headlines. They're buying it before the chaos is visible, when everyone else still believes the system is stable. That's the power of silent preparation. Real estate, the fortress you can touch. Real estate is more than shelter. For billionaires, it's a fortress of value. And not just any property. We're talking about income-producing assets, prime urban land, and strategic commercial locations. In uncertain times, real estate provides something few assets can: control. You can develop it, lease it, refinance it, or hold it. Unlike a volatile stock, real estate gives you long-term leverage. Let's take the example of post-crisis America. After the 2008 crash, while the middle class was still recovering, billionaire investors like Warren Buffett and Blackstone were scooping up undervalued real estate at scale. By the time the market recovered, they had turned those distressed assets into generational wealth. In 2023 and 2024, we saw the same move happen again, this time on a global scale. As interest rates surged and property values wobbled, the wealthiest investors quietly bought up assets that had long-term potential. And once again, They focused on control over speculation. Why these assets? You might be wondering, with tech, crypto, and other high-growth options out there, why go back to old-school assets like gold and real estate? The answer is simple: resilience. Both assets are immune to the chaos that wrecks other markets. They're not tied to digital platforms. They're not dependent on trust in banks or governments. And that makes them extremely valuable when that trust starts to erode. Let's not forget, the U.S. debt just passed $35 trillion. Inflation continues to chip away at everyday savings. Global tensions are rising. These aren't just headlines, they're signals. And billionaires are reading them clearly. The moves you don't see on CNBC. What makes billionaire strategies so powerful is that they don't wait for approval from the media or validation from social trends. They anticipate risk. They prepare before the storm. While most people are watching the stock market or checking crypto prices, billionaires are talking to gold dealers, acquiring distressed properties, and locking in long-term real estate financing while they can. These are the moves that don't make headlines, but they shape the future. Key takeaway. Here's what this all means for you. Billionaires aren't lucky. They're not just smart. They're positioned. They prepare for bad times by moving into assets that don't lose value when the system does. Real estate. These aren't luxury plays. They're survival moves. And they've worked for centuries. If you're only looking at what's trending, you're missing what's enduring. And the people who understand that win quietly every time. Chapter 2. The Buffett, Dalio Playbook. If you want to understand how the wealthy stay wealthy, even during the worst economic storms, you don't need to reinvent the wheel. You just need to study the right people. Two names stand out: Warren Buffett and Ray Dalio. Their approaches are different, but they follow the same core principle: when uncertainty rises, move to real assets. This chapter uncovers how two of the world's most successful investors have used gold and real estate not just to protect wealth, but to grow it in times of crisis. Warren Buffett, real estate as a cash flow fortress. Warren Buffett is famously cautious about gold. He prefers assets that generate cash. And for him, real estate hits that sweet spot. Let's rewind to 2011. In one of his annual letters to shareholders, Buffett broke down two choices: gold and farmland. Gold, he said, just sits there. But a farm? It produces food. It provides value. And its yield rises with inflation. That's where Buffett's logic kicks in. He's not interested in flashy bets. He wants predictable, income-generating, long-term assets. This thinking is exactly why Berkshire Hathaway invested heavily in real estate-related businesses after the 2008 crash. While the housing market was in chaos, Buffett was buying homebuilder stocks, mortgage companies, and REITs. These were not random picks. He saw undervalued cash flow and a system that would eventually rebound. In fact, in 2020, when everyone panicked about the future of commercial real estate during COVID-19, Buffett's team quietly invested in real estate-adjacent businesses with strong fundamentals and long-term prospects. Buffett's message is clear: when chaos hits, don't run. Buy productive assets at a discount and wait. Ray Dalio, the gold standard for uncertainty. Ray Dalio is a different kind of investor. As the founder of Bridgewater Associates, the largest hedge fund in the world, Dalio has always looked at macro risk, debt cycles, inflation, currency collapse, geopolitical tension. And what does he recommend over and over? Dalio doesn't think of gold as a commodity. He sees it as a strategic reserve, a form of money that exists outside of the system. In his book Principles for Dealing with the Changing World Order, he outlines how every empire follows a pattern of rise and decline, and gold is a constant throughout history's biggest collapses. Bridgewater's portfolio has, for years, quietly maintained gold positions through ETFs and physical holdings. In 2020, Dalio stated bluntly, "Cash is trash." Because when governments print trillions of dollars, your dollars become worth less. Gold, on the other hand, holds value. And it's not just talk. In Bridgewater's all-weather portfolio model, a blueprint for surviving any economic condition, gold is a core pillar. In short, Buffett leans on productive real estate with strong cash flow. Dalio leans on gold to hedge against systemic collapse. But both are saying the same thing. Don't rely on fiat currency when the storm comes. Own assets that hold real value. How the wealthy read signals differently. The most striking part of this playbook isn't just what these billionaires invest in, it's when they act. Most investors follow trends. Billionaires follow signals. Rising inflation? They move early. Weakening currency? They diversify out of cash. Excessive debt levels? They protect their purchasing power. And they never wait for media confirmation. They act long before the average person understands what's happening. For example, before the 2008 crash, Dalio was already adjusting his portfolio for a financial reset. And Buffett was sitting on massive cash reserves, ready to buy when others were selling. By 2009, while average Americans were still reeling from job losses and foreclosures, Buffett and Dalio had already begun planting seeds that would yield billions in returns over the next decade. Lessons you can apply. You don't need $1 billion to act like a billionaire. You just need to understand their mindset. Don't chase hype. Chase value. Own what the system can't print. When everyone is comfortable, prepare. When everyone panics, execute. Whether it's buying a small rental property or gradually building a gold position, you can start aligning your portfolio with strategies that have stood the test of time. You won't see Buffett trading meme stocks. You won't find Dalio betting on crypto pumps. But you will see them doing one thing consistently, building positions in real, resilient assets, while everyone else is distracted. Final thought for this chapter. Buffett and Dalio don't just invest. They build shields. Real estate and gold are their tools, not for short-term profit, but for long-term security and leverage. If you want to play the long game like they do, don't ask, "What's hot right now?" Ask, "What holds value when nothing else does?" Because that's where the smart money always ends up, right before the rest of the world catches on. Chapter 3. What the banks aren't telling you. We grow up believing the financial system is built to protect us. Central banks manage inflation, interest rates help control the economy, and commercial banks keep our money safe. But when the system begins to crack, the elite don't listen to headlines. They watch what the banks are actually doing. And what they've been doing recently is alarming. Central banks are buying gold at record levels. Commercial banks are tightening lending. Global real estate portfolios are being quietly reshuffled. So the question is, what do they know that the rest of us don't? This chapter reveals what's happening behind the curtain, and why billionaires are racing to protect their wealth while the average person is being told to stay calm and trust the system. Central banks, the ultimate gold buyers. Here's a fact you won't hear on most financial news channels. Central banks themselves are buying gold more than at any point in the last 50 years. In 2022 and 2023 alone, global central banks, especially in emerging markets like China, Russia, Turkey, and India, bought over 1,000 metric tons of gold per year. That's not diversification. That's a signal. When the very institutions that print money start hoarding gold, it's because they no longer trust fiat currency, including their own. And here's the twist. These same institutions often downplay the value of gold in public policy while aggressively acquiring it in private. Billionaires are watching. They see this for what it is, a silent admission that the monetary system is unstable. If central banks are moving out of paper and into gold, shouldn't you be asking why? Commercial banks, quiet moves, big warnings. While central banks stock up on gold, commercial banks are doing something equally revealing. They're tightening credit and increasing exposure to hard assets. In the past 2 years, major institutions like J.P. Morgan Chase, Bank of America, and Citigroup have ramped up their own investments in real estate-backed assets and quietly cut off lending to riskier sectors. And take a closer look at their balance sheets. Many of these banks are reallocating toward inflation-protected securities, short-duration bonds, and yes, even gold ETFs. Banks won't tell you that they're worried about a coming storm, but they're preparing for it anyway. Meanwhile, the average saver is told to keep their money in checking accounts earning 0.5% interest, while inflation silently eats away at its value. This isn't just misalignment. It's manipulation. The institutions meant to guide you? They're preparing for a different reality, one that you're not supposed to see coming. Real estate, the new global reserve for the elite. You might think of real estate as just homes and office buildings. But for billionaires and major institutions, it's more than that. It's a global reserve asset. In the last 5 years, there's been a tidal wave of wealthy investors moving capital into physical property, not just in the US, but across the world. In London, luxury apartments are being snapped up by international billionaires at record prices. In Miami and New York, entire condo floors are being bought in cash by private trusts. In Dubai and Singapore, real estate demand from the ultra-rich has created price booms even during global slowdowns. But because in uncertain times, property is power. It can't be hacked, inflated away, or destroyed by digital crashes. It provides privacy, control, and leverage. It's no accident that black money, sovereign wealth, and corporate executives are all doing the same thing, getting out of paper and into physical land. And yet, this move is rarely publicized. Because the longer the average investor stays in stocks and savings accounts, the longer the system stays afloat. Why you're not supposed to know this? If the majority started thinking like billionaires, the system would break. It depends on your trust, in banks, in the dollar, in promises of safety. So instead we're told, gold is outdated. Property is risky. The economy is strong. All while the top 1% and the very institutions pushing that narrative are moving in the opposite direction. Think about it. If the dollar was so secure, why are governments, banks, and billionaires hoarding gold? If the housing market was too volatile, why are elite investors buying global real estate in bulk? The truth is hidden in plain sight. The real playbook isn't public. No one will hand you the map. But if you follow the moves, not the headlines, you'll start to see the real game unfold. Billionaires don't rely on banks to protect them. They don't wait for news reports to confirm trends. They move before the panic. Boys, code. Real estate. These are not reactive investments. They are defensive strategies, and offensive ones too, used by the people who understand that the system can bend, break, or reset at any time. You don't have to play the same game as the masses. You can follow the path already carved out by those who've survived and thrived through every economic storm. Conclusion: the secrets billionaires never say out loud. Here's the truth. Billionaires don't talk about what really makes them rich. They talk about businesses. They talk about markets. But when things get uncertain, when currencies wobble, debt soars, and trust erodes, they don't chase headlines. They build moats around their wealth. And those moats are almost always the same. Called real estate, privacy, timing. This video wasn't just about where the money goes in times of crisis. It's about a mindset, a different way of seeing the world. One that separates those who survive from those who lose everything in the storm. The untold truth, it's not about returns, it's about control. You've heard it said that rich people look for ROI. But here's what they're really doing. They look for control. Control over time. Control over volatility. Control over their wealth when the system fails. Gold gives them protection. Real estate gives them leverage. Cash gives them flexibility, but only temporarily. And information? That's the real power behind it all. They don't wait for the news to confirm the problem. They act on data, not emotion. And more importantly, they position early, when the masses are still laughing, distracted, or in denial. What they do that you're never taught. In school, no one tells you how the rich really protect themselves. You're taught to save money in a bank account, to trust the stock market over the long term, to avoid risky assets like gold, to rent instead of own. But billionaires are taught something else, usually in private boardrooms, quiet dinners, and generational wealth meetings. That gold isn't about getting rich. It's about not going poor. That real estate isn't just a house. It's a cash flow machine, a tax shield, and a legacy vehicle. That debt, when used strategically, builds empires, not chains. That the system isn't broken. It was never designed for you to win. And while the average person fights to save a little more each month, the wealthy are moving large sums quietly into assets that will outlive recessions, inflation, and even entire currencies. The ultimate advantage, early awareness. By the time something becomes common knowledge, it's already priced in. The elite aren't reacting to inflation. They've been preparing since interest rates were near zero. They're not fleeing the dollar. They've been reallocating to gold since central banks started printing. They're not scrambling for real estate. They were buying when fear was highest and prices were lowest. You won't see these moves trending on social media. But they're the moves that build intergenerational wealth. So the question isn't, what are billionaires doing today? It's, what were they doing 2 years ago when no one was paying attention? That's what you need to see now, because your window to act is before the rest of the world catches up. Your next step starts here. You don't need to be a billionaire to think like one. Start small. Learn deeply. Move strategically. Consider reallocating a portion of your cash into hard assets. Think beyond price. Look at resilience, privacy, and control. Educate yourself on how money works, not how they tell you it works. Because once you understand how the game is really played, you'll never unsee it. And once you shift your mindset from chasing wealth to protecting and positioning it, you're no longer playing defense. You're building power, quietly, steadily, and without permission. Final words, bold steps forward. If this message connected with you, if you now see the cracks in the system and the hidden strategies behind the headlines, then you've already taken your first bold step forward. But don't stop here. Like this video, share it with someone who still believes the system was built for them. Subscribe to Bold Steps Forward, because the more you know, the better you protect everything that matters. This isn't just information. It's a blueprint for survival, for strategy, and for wealth that lasts longer than the next cycle. The billionaires aren't waiting. Why should you? How to avoid the fake exchange rate trap in Forex investing, USD volatility explained. When the US dollar spikes or tumbles, investors rush to buy or sell, hoping to catch quick profits. But behind these moves lies a dangerous trap, the illusion of profit created by fake exchange rates. This hidden danger lures thousands of investors into making poor decisions based on incomplete information, hype, or short-term fluctuations. Imagine converting your hard-earned money into foreign currency when the dollar appears strong, only to realize days later that the rate you got wasn't what the market truly reflected. Or worse, buying into a foreign asset thinking you're hedging wisely, but the spread or manipulated local rates eat into your actual returns. In this episode of Bold Steps Forward, we dive into one of the most overlooked risks in currency investing, the psychological and structural trap of fake exchange rates. This is not just about Forex charts or technical indicators. It's about how smart investors protect themselves in an environment where volatility can be manufactured and manipulated. We'll uncover how exchange rates are presented differently across platforms, creating illusions of opportunity. The spread between official and real exchange rates in certain markets. Why retail investors often get trapped chasing momentum moves in USD, missing out on the long-term macroeconomic indicators. Key lessons from financial veterans who've made and lost millions betting on currency shifts. If you're thinking about investing in foreign currencies, or even if you're just holding assets affected by USD fluctuations, real estate, gold, offshore accounts, this video is your early warning signal. Don't just trade on the rate you see. Understand the real value behind the numbers. Stay with us until the end. We'll share exclusive insights on how hedge funds and institutional investors read between the lines, and how you can apply the same logic to protect your money and build smarter strategies. Subscribe to Bold Steps Forward for more real-world finance insights that global investors can trust. Chapter 1. The hidden risk behind the numbers, what most investors miss in currency markets. On the surface, exchange rates seem straightforward. You look at the current USD to euro rate, let's say it's 1.08, and you assume that's the value you'll get when converting your dollars. But here's the catch. Most investors, especially beginners, fail to realize that this number is often just a headline. The rate you see is not always the rate you get. This illusion, often referred to as the fake exchange rate trap, can quietly eat into your profits, or worse, create losses where you expected gains. Let's take a real-world example. During the volatility of early 2022 and 2023, as the Federal Reserve hiked interest rates to combat inflation, the dollar surged against nearly every major currency. Retail investors watching financial news thought, now's the time to convert to emerging market currencies or buy into overseas ETFs. The dollar is strong, I'll get more for less. On paper it looked smart, but in reality, many of those investors were hit with fees, spreads, and local conversion rates that made the trade deeply inefficient. The problem stems from the spread between official interbank rates and retail accessible rates. Central banks and institutional investors operate at privileged levels. They trade currency in large volumes with razor-thin margins. Think 0.01% to 0.03%. But for an everyday investor, that same transaction may involve a 2% to 4% markup from banks or brokers. On a $100,000 conversion, that's a $2,000 to $4,000 difference, gone before your investment even begins. Now, imagine making that move in a foreign market where capital controls or dual exchange rate systems exist. In countries like Argentina, Nigeria, or even China during certain periods, the difference between the official government rate and the actual black market or business rate can be staggering. This means an investor could unknowingly be working with a rate 30% to 50% worse than expected. This isn't just a developing world issue. Even in Europe or Japan, currency moves can be front-run by algorithmic traders, making intraday rates highly volatile and hard to time. Many traders see a favorable rate, act on it, and by the time the transaction processes, the rate has moved. The difference is called slippage, and it's another form of hidden loss that rarely makes headlines but heavily impacts returns. Let's go deeper. Why does this trap happen, and why is it so dangerous now? The short answer: the rise of algorithmic and speculative trading in forex markets has made currencies move faster and more irrationally than ever before. The US dollar, being the global reserve currency, reacts instantly to interest rate hikes, geopolitical tension, inflation reports, and even social media panic. What looks like a trend is often a temporary spike fueled by emotional capital and fast money. And when you combine that with deceptive exchange rate displays on apps or platforms, especially those that don't show full fee breakdowns, you're setting yourself up to chase a ghost. So what can smart investors do differently? First, understand where the rate is coming from. If you're using an app, is the exchange rate shown the interbank rate, or is it the retail rate including markups? Always check. Apps like Wise and Revolut have become popular because they show real-time mid-market rates, but many traditional banks still present a skewed version of the truth. Second, learn to recognize macro versus micro-currency shifts. A short-term movement in USD doesn't necessarily reflect long-term economic reality. In 2023, for example, the dollar spiked against the yen after rate hike announcements, but those gains were quickly erased when Japan intervened in the currency market. Retail traders who bet on continued USD strength were wiped out within days. Institutional investors, meanwhile, had already hedged their exposure and walked away untouched. Third, don't forget the real cost of switching currencies. If your goal is to invest abroad, sometimes it's better to hold your base currency and buy ETFs or foreign assets that are USD denominated, rather than converting outright. Platforms like Interactive Brokers or Fidelity offer access to global markets without forcing a currency conversion up front. This lets you ride foreign market trends without exposing yourself fully to FX risk. And finally, stop treating the dollar like a stock. The USD is not a growth asset. It's a representation of economic power, stability, and trade flows. When you buy or sell it, you're making a bet on not just American interest rates but also global demand for U.S. treasuries, geopolitical risk, and inflation trends. That's a lot to wrap into a single decision, especially if you're only watching a chart on your phone. Teaser for next chapter. In the next chapter, we'll explore how professional hedge funds and high-net-worth investors approach currency investing, not as a guessing game, but as a calculated hedge. You'll learn the strategies they use to detect real versus manipulated exchange rate movements, and how they protect their capital with precision. Chapter 2. How the smart money sees currency, inside hedge fund strategy and FX risk management. Retail investors often react to what they see on the surface: a rising US dollar, a collapsing yen, or a sudden spike in the euro. But the professionals, hedge funds, institutional investors, and multinational corporations play an entirely different game. They don't just look at the number flashing on the screen. They understand the why behind it, the timeline, and most importantly, the risk that comes with chasing it. Let's start with a fundamental difference. Retail investors chase price, but hedge funds manage exposure. This distinction is critical when it comes to currency. While the average investor might look at a 2% jump in the dollar and try to capitalize on it, a hedge fund manager asks a more important question: is my portfolio exposed to this move? And how do I protect my returns if the trend reverses overnight? Take Bridgewater Associates, the world's largest hedge fund, for example. During periods of dollar strength, they don't simply convert billions into foreign currency. Instead, they use hedging instruments like forward contracts, options, and currency swaps. These tools allow them to lock in rates, define risk parameters, and maintain liquidity, all without actually exchanging physical currency unless absolutely necessary. That's the first key lesson. Professional currency strategy is more about risk control than speculation. Now let's go deeper. How do they detect when a currency move is real or just short-term noise? Hedge funds rely heavily on macro indicators and flow data. For instance, if the dollar is gaining strength, they don't take it at face value. They ask, is this move supported by rising U.S. Treasury yields? Are capital flows coming into U.S. assets like equities and bonds? What's the real interest rate differential after inflation? Are central banks like the ECB or BOJ signaling a response? If the answers don't align, they might fade the move, betting that the dollar strength is temporary. But if capital inflows are sustained and macro policy aligns, that's a signal to reposition portfolios and hedge accordingly. Retail traders, by contrast, often get trapped in the confirmation loop, seeing the rate move and assuming it will continue. By the time they act, the smart money has already repositioned. Another powerful tool institutions use is currency baskets. Instead of trading one pair, like US dollar to Japanese yen, they monitor relative strength across a range of currencies. This helps them spot broader trends and avoid overexposure to just one economic story. For example, if the dollar is rising against the yen but flat against the euro and pound, the move might be more about Japan than the US. Understanding this nuance prevents false assumptions. Professional investors also factor in geopolitical catalysts. In 2022, when Russia invaded Ukraine, global investors didn't just flee to the dollar. They analyzed secondary impacts, how European energy markets would respond, how commodity-linked currencies like the Canadian dollar and Australian dollar might behave, and how inflation would reshape global rate expectations. These are layered dynamics that most retail traders never consider. So how can an individual investor apply these insights? First, stop trading currency like a gamble. If you're not using proper risk tools, like stop losses, position sizing, and timing filters, you're not investing, you're betting. Professionals define risk before they take a position. You should too. Second, consider indirect exposure. Rather than converting currency directly, you can gain global diversification through ETFs that are already hedged. For instance, many international equity funds offer currency-hedged versions that protect your returns from FX swings. This approach mirrors how institutions gain foreign exposure while minimizing volatility. Third, pay attention to central bank policy divergence. The real fuel behind most major currency moves isn't breaking news. It's slow-moving but powerful policy shifts. When the Fed tightens while others hold, the dollar rises. When global central banks synchronize, volatility narrows. You don't need a Bloomberg terminal to follow this. Just track central bank meetings, rate decisions, and inflation targets. And finally, learn the value of doing nothing. Some of the smartest investors sit on the sidelines when markets are irrational. When currencies move without macro support, or when headlines drive panic, it's often better to wait. Hedge funds with decades of success have one thing in common. They preserve capital first, then look for returns. Real example, George Soros versus the Bank of England. Let's not forget one of the most famous currency trades in history, George Soros short against the British pound in 1992. Soros didn't act on price action alone. He studied the UK's economic position, its unsustainable commitment to the ERM, European Exchange Rate Mechanism, and knew the government couldn't hold the pound's artificial value. It was a calculated bet based on deep analysis, not instinct. When the Bank of England tried to defend the pound, Soros increased his position. He had conviction backed by data, policy knowledge, and risk management. Retail traders remember the $1 billion profit. But what they often miss is why the trade worked. Soros wasn't betting on volatility, he was betting on inevitability. Teaser for next chapter. In Chapter 3, we'll dive into the psychology of FX investing, why most people misinterpret currency moves, how emotional decisions destroy returns, and how to reframe your mindset to think like a global strategist instead of a local trader. Chapter 3. The Psychology of Currency Investing, Why Most People Get It Wrong. The hardest part of currency investing isn't the math. It's not the charts, the central bank statements, or even the volatility. The real challenge lies in the mind. The decisions people make based on fear, hope, and misperception. Currency moves are fast, dramatic, and often fueled by headlines. This triggers the most dangerous reaction in investing: emotional decision-making. The human brain is wired to respond to urgency. So when we see a news flash, dollar surges to 20-year high. Our instinct is to act. We fear missing out. We fear losing money. And we want control. But here's the problem. Reacting to short-term price moves in currencies often leads to buying high and selling low. Because by the time the story hits the mainstream, the professionals have already acted. What you're seeing is often the tail end of the move, not the beginning. Let's break this down. The mirror illusion of the USD. Many investors believe that a rising US dollar equals a strong American economy, and a falling dollar means weakness. This is rarely the full picture. Currency strength is relative, not absolute. The dollar doesn't rise or fall in a vacuum. It rises against other currencies. If the Eurozone is in crisis, or Japan is locked in deflation, the dollar might rise even if the US economy is facing headwinds. This is the first psychological trap, assuming the dollar reflects America's economy alone. In reality, it's a scoreboard of global confidence, trade imbalances, and cross-border capital flows. If you interpret the dollar like a stock, you're bound to misread its movement. Overconfidence and the "I know the trend" bias. In currency investing, past performance creates a false sense of security. Let's say the dollar rises for 3 straight months. The human brain begins to project that trend forward. It's going up, so it will keep going up. But in forex markets, trends can reverse sharply due to policy changes, unexpected data, or geopolitical risk. The same momentum that lifts you can crush you. Hedge funds understand this. That's why they never bet on a move without a hedge or an exit strategy. But the average investor, driven by confidence in their past few wins, starts increasing risk without protection. This leads to overexposure and often painful losses. The anchoring effect, obsessing over entry points. Another common psychological trap is anchoring. The tendency to fixate on a specific number. An investor might say, I bought euros at 1.10, and now it's 1.06. I'll wait until it returns to 1.10 to sell. This is irrational. The market doesn't care about your entry point. It cares about fundamentals, policy, and flow. Smart investors reevaluate constantly. If the fundamentals change, they cut their losses or take gains, regardless of where they entered. Anchoring creates paralysis. It traps investors in bad trades, hoping for a recovery that may never come. This is why professionals never tie their decisions to emotional benchmarks. They tie them to strategy. The illusion of action. Perhaps the most damaging mindset in FX investing is the illusion that doing something is always better than doing nothing. Currency markets trade 24/7. There's always movement. This makes investors feel they have to act constantly. But real power comes from discipline, not activity. Legendary traders like Stanley Druckenmiller or Ray Dalio didn't build their success by trading every day. They waited, they watched, and they struck when the conditions were right. In currency investing, patience is a strategy. If you're constantly in and out of positions because you don't want to miss out, you're playing defense against your own emotions. That's not investing, that's reacting. Reframing your mindset from local trader to global strategist. To escape the psychology traps of currency investing, you need to think globally, act strategically. Here's how. Zoom out. Don't just follow the US dollar, follow global flows. Understand how policies in Europe, Asia, and emerging markets impact exchange rates. Currency is a reflection of global interdependence. Focus on fundamentals, not forecasts. No one can consistently predict short-term currency moves. But you can understand the drivers: inflation, trade balances, interest rate differentials, political stability. Use FX as a hedge, not a bet. The smartest investors use currencies to reduce risk in their portfolios, not to get rich quick. If you're invested in European stocks, consider how the euro impacts your returns. Align your exposure with your goals. Accept uncertainty. Currency markets are unpredictable by nature. You will be wrong sometimes. The key is to be wrong small and right big. Build a system. Professionals follow rules, not feelings. You should have clear criteria for entering, exiting, and adjusting positions. That discipline protects you from emotional overreach. A lesson from the pros. In 2015, when the Swiss National Bank unexpectedly removed its currency peg to the euro, the Swiss franc surged 30% in minutes. Thousands of retail traders were wiped out. But the professionals who had modeled for tail risk, even if they thought it was unlikely, were protected. Because they didn't assume anything. They planned for chaos. That's the mindset you need. Not to predict the future, but to prepare for its many possibilities. Teaser for the final chapter. In the final chapter, we'll reveal real-world strategies that most individual investors never hear about. Secrets used by currency veterans to turn volatility into long-term opportunity. These aren't trading tricks. They're frameworks that have stood the test of time. Chapter 4. Turning currency volatility into opportunity. Lessons the pros don't tell you. After understanding the traps of fake exchange rates, the psychology pitfalls, and how hedge funds manage currency risk, the final step is learning how to turn this volatile, confusing market into a source of consistent long-term gains. Currency investing is often seen as a risky gamble. But the truth is, with the right mindset and strategies, you can transform volatility into your advantage. Here are the key lessons most investors don't hear. 1. Focus on long-term value, not daily fluctuations. Currency markets move every second, but real value shifts slowly. Professional investors think in months and years, not minutes and hours. Instead of reacting to every headline, focus on the fundamental trends: inflation differentials, trade balances, interest rate cycles, and geopolitical stability. For example, the dollar's strength in the 1980s wasn't overnight. It reflected years of economic policy and global shifts. Those who understood the macro picture positioned themselves early and held firm. 2. Use currency diversification as a portfolio hedge. One of the most powerful, yet underappreciated, tools is currency diversification. Holding assets in multiple currencies can reduce portfolio volatility and protect against shocks. Global investors increasingly use currency-hedged funds to protect gains from sudden FX swings. But savvy investors sometimes unhedge selectively to gain exposure when long-term trends favor a particular currency. 3. Build carry trades carefully. A classic hedge fund strategy is the carry trade, borrowing in low-interest rate currencies, like the Japanese yen or Swiss franc, to invest in higher-yielding currencies or assets. While risky, carry trades reward patience and risk management. When central bank policies diverge, this strategy can generate steady returns by capturing interest rate spreads. The key is to control risk exposure, avoid sudden reversals, and adjust positions as markets change. 4. Protect yourself with options and hedging tools. Volatility can be your enemy or your friend. Options and forward contracts allow you to limit downside risk while retaining upside potential. Many retail investors avoid these instruments because they seem complex. But with education, you can use options to ensure your portfolio against sharp adverse moves, just like institutional investors do. 5. Monitor global policy and be ready to adapt. Currency markets respond to central bank actions and geopolitical events. To succeed, stay informed about Fed meetings, ECB policies, trade agreements, and global crises. But more importantly, be ready to adapt your strategy quickly. Markets evolve. What worked last year may fail this year. Flexibility and continuous learning are your greatest assets. 6. Avoid the chasing returns trap. Lastly, don't fall into the trap of chasing last month's winning currency. Volatility creates heroes and losers every quarter, but winners are those who build sustainable strategies, not who gamble on momentum. Final thoughts. Currency investing isn't about predicting every swing or chasing fast profits. It's about understanding the global economic chessboard, managing risk carefully, and acting with patience and discipline. The fake exchange rate trap is just the first hurdle. The deeper challenge is mastering the psychology and strategies that turn volatility into wealth. If you commit to these principles, focus on fundamentals, use hedging, diversify, and think long-term, you can protect your capital and seize opportunities the majority miss. If you found these insights valuable, subscribe to Bold Steps Forward for more in-depth, practical finance strategies tailored for global investors like you. Like and share this video to help others avoid costly currency traps and build smarter portfolios. Remember, smart investing isn't about luck. It's about bold, informed steps forward.